I acknowledge that I'm hosting this webinar from the lands of the Gadigal people of the Eora Nation. I also acknowledge the traditional custodians of the various lands on which you all work today and the Aboriginal and Torres Strait Islander people participating in this webinar. Your webinar presenters today are Corporate Tax Partner and Manager Joel and Joey Wang. Now, without further ado, I'll hand it over to Joel.
Thank you, Tanya, and good morning to you all and good evening to some of you. Just a quick run through of where we would like to take you today. First of all, a bit of a focus on ATO's latest programs in relation to multinationals. Quite a bit in relation to ThinCap and also some changes in relation to recent guidance from the Tax Office, hot off the press on the debt deduction creation rules. A bit of an update on the progress with the domestic implementation on Pillar 2 taxation and the two key rules that apply to multinationals there. Then I'll hand it over to Joey to discuss two issues: intangible assets and royalties and country by country reporting and recent developments there and practical guidance that may affect you or in some cases affect your clients. Finally, I will touch on a little bit in relation to recent changes in necessary reporting in relation to the foreign resident CGT regime and a new reporting regime that we expect to be implemented, but with a range of different areas that remain unresolved, and give you a bit of an update to that one. First of all, a bit of an update in relation to multinationals and the tax office's programs to gain assurance around the particular taxpayer groups, in particular of where we've got situations of taxpayers with Australian turnovers exceeding $250 million. While we haven't had any recent updates on that, we'll see both from this slide and the one that follows, there are four key areas that the tax office have identified as being the focus of their engagement with taxpayers in this particular population. In particular, transfer pricing, ThinCap and hybrid mismatch, withholding tax, intangibles and royalties, and also foreign resident on capital gains tax. And especially those last three there that you see on the slide, we will be going into a little bit of detail around what type of issues are current in the market for multinationals. In addition to all of those focus areas there, you'll also see that we've had some recent case developments in relation to R&D and also recent transfer pricing developments. One thing we are seeing a lot of change in the market is the extent of the tax office's engagement with multinational taxpayers around tax governance documentation. And this, while it is fairly well understood by boards at a sort of a top 100 level, we are seeing that it's increasingly important for taxpayers who are at around $250 million for their boards and their finance functions to become increasingly aware of the tax office's expectations to have a full level of documentation for tax governance, meaning the way that risks are managed and dealt with through the board process and how they are identified. And the key aspects to that are, of course, both the documentation of each one of those processes that results in having assurance around correct disclosures of tax and also of tax risks, but also increasingly the tax office has been showing an interest in understanding not just the documentation, but the practical implications of who is actually conducting the practical walkthroughs and the identification of risk. So more than just a static document, they're very keen to see how it is that taxpayers are actually managing their risks, identifying their risks, and who's actually involved in making the documentation in relation to tax governance live. Moving down to ThinCap. Now, for some taxpayers in this area, ThinCap is not something that's a significant consideration, but for a number of taxpayers that we come across, the changes to the approach in ThinCap to more closely align with OECD practice has been a very substantial change and has created quite a deal of, in some cases, concern and extra compliance. In other cases, it means that there are a series of rules which were quite challenging, and perhaps less so now. So I'll be both looking at the changes and a few of the practical implications that we see, because we are coming into the first period under the new rules, and also to talk about the debt deduction creation rules and new practical guidance that's come out from the tax office, and also has generated quite a bit of heat from the advisor community in particular, because it looks at some situations in which the debt deduction creation rules can potentially be subject to restructuring, and where how the tax office is categorizing the risks arising from restructuring to deal with the new debt deduction creation rules, and also, a color coding, as is a bit of a trend with the tax office now. They love to give color codes for all kinds of different risk ratings. So where we are at the moment, we've got the introduction of the new bill, which is to apply, and for the most part, taxpayers are now subject to that not yet final legislation, and will be coming into, in most cases, their first compliance period ending the 31st of December in the current year. So we're coming up to that first reporting period. And just recently, we've had released in conjunction with the thin cap provisions, and subject to a lot of discussion, was the debt deduction creation rules, which are also included in substantially the same form that we had originally seen. And that has created a great deal of concern and I suppose a lot of questioning, because it does also apply to historical transactions. Now, just to briefly run through what's changed in terms of the local FinCap rules, you see there, in terms of just the rules that are applied there, in summary, you'd say that where previously our domestic FinCap rules had been applying a balance sheet-based approach, that now these have moved substantially over to the default being the fixed ratio test, which is essentially a tax-based EBITDA approach, and permitting an interest deduction of up to 30%. And look, a couple of key issues to identify here, or with these changes, is although we do have a group ratio test and a third-party debt test, which have some similarities to the old worldwide gearing test and to the arm's length debt test, as a practical matter, we are seeing that those two alternative tests to the default fixed ratio as being much less frequently able to be accessed. And simply put, the reasons for that is that the level of information for the group ratio test requires comprehensive analysis of all entities within the particular multinational group, and in particular, what their EBITDA is. Now, that may be applicable for smaller MNEs, but for much larger groups, especially inbounds where accessing information upstream and from parent groups is unlikely to be feasible or practical. On the third-party debt test, I suppose what we see from that is, whereas it does have some relationship with the previous arm's length debt test, it is much less, or it's much more rigid and prescriptive, because whereas under the previous test, we were allowing taxpayers an extent of debt attributable to their Australian operations, which matched up with what they could reasonably expected to raise from arm's length parties and what was reasonable for them to maintain and have a sufficient equity return. Now it's very prescriptive in terms of requiring that the debt in question does actually come about from third parties, and also that the extent of the security provided for that debt is essentially restricted entirely to the Australian operations and cannot have reference to overseas securities of more than a trivial amount. And so that does very much bring us back to considering the FinCap provisions as a focus for most taxpayers on how it is that the fixed ratio test will apply to those taxpayers, being 30% of tax EBITDA. And what we see as being the key changes in that market is that, especially if you're in industries which have significant property involvement, previously under the balance sheet based approaches, these have been allowed a level of debt which is probably significantly higher than is now permitted under a 30% of EBITDA regime. Similarly, there are some other businesses or M&Es who are in the thin cap space, who find that in terms of the fixed ratio test, that they have, relatively speaking, a much higher EBITDA ratio compared to the extent of their balance sheet. And what was previously a problem in terms of testing for thin cap is much less than it was under the previous regime. And with that possibility in mind, there is also a need to consider the debt deduction creation rules. And in particular, with these rules, what do they deal with? Essentially, there's two specific areas that we need to identify, and I'll run through a couple of common scenarios in which the tax office has identified that the debt deduction creation rules can apply. And the first one is where we've got an entity which acquires an asset from an associate, and it's that purchase of an asset is funded by debt. And that's what they call, in the practical compliance guideline, a type 1 debt deduction creation situation. The second involves where there's a situation of an entity borrowing from associates to fund certain payments, for example, dividends. And so both of those have a situation where the policy concern is that that's created debt and deductible debt within the jurisdiction, which can then be subject to the debt deduction creation rules. An important thing to note about the debt deduction creation rules is they actually sort of sit separately to the thin cap provisions. And when originally announced, there was a little bit of a concern, well, how do these two provisions interact? Well, we've had that clarified more recently to say that, first of all, we have to consider the debt deduction creation rules. And only then, if we have not been denied deductions by that, can we consider those debt deductions under the thin cap provisions. Now, the general rules for the applicability of the thin cap provisions are generally maintained, which is that you will be within the thin cap provisions if your debt deductions, including those of your associates in Australia, Australian debt deductions exceed $2 million. There is also still available an exemption for groups that are more than 90% Australian-based, but it's important to note that in terms of the debt deduction creation rules, that 90% Australian-based assets is not applicable. So you still have to apply the debt deduction creation rules in those circumstances. Now, there's a small gap in the initial implementation. While a lot of taxpayers are coming into their 31 December 24 and applying the new thin cap rules, most of those 31 December balances will not need to apply the debt deduction creation rules for an additional year. And part of the thinking with that is that, especially when originally released, that the debt deduction creation rules have a retrospective effect. That is, if a multinational has entered into either a type 1 or a type 2 arrangement in the period before the debt deduction creation rules were in force, those can still be denied deductions under the debt creation rules. And practically speaking, why that's incredibly difficult for many taxpayers is it does require essentially a trawling back to understand the source of any particular transaction that might have been undertaken in the past, which is now currently giving rise to debt deductions or has its source from that. And practically speaking, the tax office has said that their approach to this will be that they expect taxpayers to be able to discharge a burden of proof as to whether or not a type 1 or a type 2 debt deduction creation arrangement has taken place in the past. And to the extent they can't be satisfied or document that type of situation, that they should not be claiming tax deductions. Now, of course, that's extremely challenging given that these rules in many cases will apply to transactions that have stretched back, 20, 30, possibly even longer periods. And the tax office has said that, in certain situations, they'll allow an apportionment of debt, but that's not really a substitute for pursuing the factual basis for whether or not you have, in fact, undertaken an acquisition from a related party that is subject to these rules. And then just, I think it's 2 weeks ago, we had the release of PCG 2024 D3, which is indeed a bit of a mouthful. And I suppose we got quite a few different things out of that particular PCG for those people impacted in this market. And one thing it does do, and I won't run through each one of those situations, but it does identify common, ordinary corporate scenarios in which the debt deduction creation rules really do need to be applied. And also it sets out a schema for, so I'll take a step back. Within the debt deduction creation rules, there's a specific anti-avoidance provision that sits within that says, that deals with or negates any type of a restructure which would seek to avoid the operation of the debt deduction creation rules. And that one has been a particular concern, and I suppose for that reason, the PCG or some kind of guidance is very useful to a lot of taxpayers. Now within that, it does identify color coding for various different types of transactions undertaken to respond to the debt deduction creation rules and allocates them colors which are white, which is of course if you've interacted with the tax office to determine your situation. Green, which is situations in which a debt deduction creation arrangement or a process for dealing with those new rules is identified by the tax office as being low risk, and that's categorized as green. And you'll find that if you're looking for that PCG, it's set out at Schedule 1. And then at the other end of the spectrum, the tax office within that PCG also identifies at Schedule 2 a range of different reactions to the debt deduction creation rules, which they identify as being high risk. That's allocated red, and if you can't find what your situation within that, they call that yellow, so a medium risk situation. Now, a couple of different things there to consider is certainly there's one issue in terms of that PCG identified as a red zone situation, which is one in which related party debt applied to financing a certain undertaking has been refinanced to an arm's length domestic lender. And in that situation, the tax office have still identified that as being a situation because it maintains the same level of deductions, albeit with an arm's length party, that it would be what they refer to as high risk. And that has concerned a lot of advisors here because essentially, if the concern is around the level of debt being maintained, that's still the tax office considering that the specific anti-avoidance provision in the debt deduction creation rules would apply. Now, I thought I would flick back for a minute to the common situations in which the PCG identifies that the debt deduction creation rules may apply. Now, generally speaking, we've got the type 1 and the type 2, which is identified with the original supplementary materials that came through with the legislation. But also what we see there is a range of 5 different other situations in which they consider that the debt deduction rules would need to be considered. Now, of course, you've got some obvious ones like acquisition of property from a related party, but also we've got situations in which, for example, global cash pooling arrangements where the Australian entities' balances fluctuate between negative and positive during an income year can give rise to a debt deduction creation rule consideration. And that's, of course, a concern for a number of taxpayers where multinationals very commonly will enter into a cash pooling arrangement where local funds are swept back to a single source back, usually in the parent group jurisdiction. So a summary of the key points to come out of this. Most taxpayers who are in the thin cap regime will be currently implementing. In common actually with the next subject that I'll discuss, Pillar 2, first of all, there is the direct income tax impact that arises from this new regime. But secondly, we see as being a really important issue to consider is quite apart from filling out tax returns, how do we gain sufficient assurance to complete financial statements on a true and correct basis? And how do we ensure that the process of audit is gone through and we can give sufficient guidance to affected multinationals in this space that they are or are not impacted by the thin cap provisions, and looking forwards to the next year, should they anticipate some kind of impact from the debt deduction creation rules or indeed Pillar 2 tax. Secondly, where denied a deduction under the fixed ratio test, there's now a provision to carry those denied deductions forwards for a maximum period of 15 years. And while the previous thin cap provisions were simple in a financial reporting and tax reporting sense, is that you either get the deduction or you don't, now finance functions will need to consider much more carefully if they are in a situation where they are not able to claim a deduction under the fixed ratio test and it is carried forward, to what extent is that future usefulness able to be treated as a deferred tax asset under the respective recognition criteria. So a reminder there that we have those 3 applicable tests which will apply effectively from the 31st of December this year. Also, that in the expanded term debt deductions, we are seeing the inclusion now of swap arrangements, and also to take care with any restructuring which has in mind a need to deal with the debt deduction creation rules. A bit of an update in relation to Pillar 2 tax has been at some distance for a little while for a lot of taxpayers. We're still waiting for more guidance on how the domestic implementation will take place and the reporting that's involved, but we do have some draft legislation that deals with it. I'll run through exactly where we are in terms of meeting the local requirements. So in simple form, the Pillar 2 provisions seek to bring Australia into line with the global anti-base erosion rules and the subject to tax rules, which in summary, for those of us who don't have to do it all the time, means the application of a minimum rate of 15%, both domestically and across multinational groups. Now, it doesn't apply to all taxpayers, so there's a particular threshold level that I just wanted to point out here, which is defined currently under the global turnover as a European, as a euro-denominated amount, 750 million euros, which for Australian taxpayers usually means $1.2 billion, but it is defined by reference to that euro turnover amount. And it seeks to align with OECD guidance that you see there. Although taxpayers are generally subject to those rules, it's important to keep in mind that there are a range of entities that are not subject to these global rules. So just a number of different types that are applicable there, and some of those will be self-evident as to why it is that the effective tax rate wouldn't be a consideration. Now, just at a simple level here, we have essentially 3 different global rules which effectively apply at different levels here. The first one, which will be initially applied at the first instance, is the qualified domestic minimum tax top-up tax, and that will deal for Australian taxpayers with a situation where their effective rate of tax is at a rate of less than 15% on domestic activities. Now, domestically, we don't expect this to be applicable to many groups within Australia, as it's infrequent to see an effective tax rate of 15% or less. But we do see that it would be possible through the key areas by which entities enjoy lower than standard 25 or 30% corporate tax rates, which are the standard within Australia. For example, the R&D concessions, if you do have a taxpayer in that area, or alternatively, in some situations, taxpayers can have a lower effective rate of tax as a result of restructures and also the reset of assets, for example, under the tax consolidation provisions. The income inclusion rules effectively seek to apply tax at least a 15% to a raft of different subsidiary entities outside the jurisdiction. And that can be applicable at a range of different levels within a tax group. So it's really looking at the application of a minimum global rate of 15% and a bunch of machinery provisions that allow the ATO to raise tax in conjunction with overseas fiscal regimes. And finally, the undertaxed payments rule, which deals with the situation where your global parent is not in a jurisdiction which is applying the globe rules. That one we see as being practically much less common, but may be, for example, in a situation where you're dealing with a multinational that has a global headquarters in the US because they are not applying the globe rules as they are currently. And what that does, in essence, is allows other entities within the corporate group to levy a tax to top up the tax rates of the affected entities within that group, according to the assets and the employees within the jurisdiction, up to a minimum rate of 15%. Now, the main one we expect to see applying for Australian resident taxpayers is where you have a situation of having some controlled foreign companies or controlled foreign entities that have effective tax rates in their local jurisdictions underneath 15%. And that is a rule which, although we don't have the reporting framework around it, will be applicable from the 1st of January 2024. We know that the application of these particular rules is established through a completely separate act. So it's not something that sits within our existing Income Tax Act. It's referred to in short in the explanatory materials as the Assessment Act. And we also don't have full overview of how exactly the reporting will take place, although we're fairly confident it will be substantially in the form of an XML schema, which is the method that a lot of you will know and love to be the basis on which we do our CBC reporting currently. So there is a working group that is in place at the moment with the Tax Office to consider how exactly the reporting for the income inclusion rule and the qualifying domestic minimum tax will ultimately come into being, but we don't have any guidance on that yet. So the rubber meets the road, I think, for most of the affected taxpayers coming into the financial reporting and assurance process that starts on the 31st of December 2024. So although we won't know exactly how it's reported, and although we have a grace period of 18 months to actually lodge these reports with the Tax Office, who have administration of the Assessment Act, really for financial reporting purposes, finance teams need to be getting ready now to deal with a question around, do you have a minimum top-up tax for domestic activities? And are you, if you have foreign activities, foreign entities, subject to the income inclusion rules such that there should be an extra tax disclosure in your Australian financial statements? I've got just a bit of a quick example there of situations and how the income inclusion rule works. So there's a lot of new language that comes through with the legislation and explanatory materials, runs to some 200 pages. And we get very used to this idea of the constituent entity, which is a range of different entities which can comprise both permanent establishments or companies. And so the task that you can see there when determining whether or not there's an income inclusion rule for ACO, or a practical income inclusion amount for ACO, depends very much on identifying all of the constituent entities and then determining what rate of effective tax each of those constituent entities is paying in each of the relevant jurisdiction. And then finally, determining whether or not the income inclusion rule requires an additional amount of tax to be payable in the Australian jurisdiction. Now that, as you can see, is quite a heavy process to be undertaken, especially when we don't have a lot of that legislation completely bedded down, nor the reporting that's included in it. And of course, this will be live in a matter of just 2 months. Now, the undertaxed profits rule, I won't go into a great deal of detail, but allows, in particular, for entities that have a ultimate parent entity, which is not one of the globe implementing jurisdictions, to tax under 15% rates for entities throughout the global group. And what that allows the tax to be applicable as throughout that particular group, the undertaxed amounts throughout the global group of less than 15% can be allocated across the remaining members. And in particular, for taxpayers who do have a US parent or a parent who's not subject to the income inclusion rule, that will also create an extra layer of complexity as you effectively, as an Australian finance team, have to determine how much tax has been paid across the group, and then whether or not an amount will be needed to be included in the Australian disclosures, such that additional tax gets payable. Now, we do have a little bit of a reprieve for those rules. You can see that they are probably a great deal more complex for teams to have to apply, and therefore they will be applicable from next tax year or the 31st of December 2025. In addition to that, Australia has now looking to implement the qualified domestic minimum top-up tax. And what this applies to is effectively applying a minimum tax to the Australian operations. Now, currently, the legislation is not yet passed, but we do expect it to be passed in its current form. What we see as being the really practical implications of this is finance teams in Australia are going to need a lot more information about the level of tax which is being paid offshore, particularly if taxpayers are subject to the undertax payments rule. The level of information required will extend out beyond just those subsidiaries for which you have oversight, and so that will require a great deal more implementation. The other thing to keep in mind is because the domestic implementation of these three rules effectively happens as a separate tax act, there will be completely separate tax compliance which is involved with it. It is administered by the Commissioner of Taxation in the same way as all other taxes. However, it does come with a completely separate administrative regime and also a separate series of rules around assessment and objections and so forth. Basically, it's a full self-assessment regime under these rules. But what we see also is, of course, the Commissioner has an ability to amend the assessments for the disclosures that are made under the QDMTT and income inclusion rules in Australia. I might now hand it over to Joey to talk a little bit about intangible assets.
Thanks, Joe. So I'll be covering the next two topics, the intangibles and then the country-by-country reporting. So firstly, intangibles. Okay. So in the last 12 months, there are probably two very important policy documents from the ATO in the intangible space. The first one is this Practical Compliance Guideline 2024 Wang. So it's about intangible migration arrangements. Essentially, this is a risk assessment framework to enable taxpayers to assess when the ATO is likely to allocate compliance resources to review whether the general anti-avoidance rules or the transfer pricing rules may apply to certain cross-border related party intangible migration arrangements. So when they speak about intangible migration arrangements, they really refer to cross-border arrangements involving migration of intangible assets or arrangements of similar effect. This could be, for example, mischaracterization and non-recognition of Australian activities collected with those intangible assets. And then those arrangements could also be related to Australia's development, enhancement, maintenance, protection, and exploitation in connection with those intangible assets that are held offshore. So you might have heard the word DEMPI in the last 2 years in the intangible space. So DEMPI is being a buzzword in this area. It essentially refers to development, enhancement, maintenance, protection, and exploitation activities related to intangible assets. So It might be easier if I give you a simple example to understand these intangible migration arrangements. Say, for instance, we have a Australian tax resident, we call it OSCO, and then it set up a new co in a foreign jurisdiction with tax concessional rate, and then it licensed all its intangible assets in Australia to this new co overseas. And then, under this intangible license agreement, there's no royalty being applied. At the same time, the OSCO is still carrying out all these dumping activities for those intangible assets. Then under this PCG guideline, it is a intangible migration arrangement. And in fact, if you go with the assessment framework, it is deemed as a high risk arrangement, which will fall under the red zone, which means the ATO is very likely to allocate review resources on this arrangement. So that's essentially what this intangible migration arrangement is. So what is the impact of this PCG to taxpayers, especially multinationals? So I think if you had previously had a migration of intangible assets arrangement and they are still ongoing, then they could be brought into the scope. And then this PCG actually does not have any materiality thresholds. So that means, companies of different sizes, be SGs, large corporates, small or medium enterprises, could all be held accountable for this PCG. And then also, if the taxpayers are contemplating any cross-border transactions involving intangibles, you will need to apply this guideline, carry out a self-risk assessment, and document the result of the assessment. And if you need to prepare a reportable tax position schedule in your tax return, you do have to disclose the result of your risk assessment. And then lastly is that documentation is also quite important when it comes to intangible related transactions, because if you don't document, you will end up in a high risk zone according to this PCG. So that's pretty much a summary of the PCG 2024-1. And then the next policy document is this draft ruling 2024-1. So this draft ruling is essentially ATO's guidance about when a payment made in respect of software and intellectual property should be deemed as royalty. So there are a few key elements coming out of this draft ruling. The first one, which is probably the most important one, is that payments for the use or right to use copyright or other like property or right or intellectual property will all be falling under the definition of royalty. And then if you are making such payments to an overseas party, then it will attract withholding tax on royalty. And the second element of this ruling is that cross-border payment made under a software arrangement is subject to this ruling. And the ATO's view on this is actually quite broad. So basically, ATO thinks that most software-related payments are royalties, except for some specific scenarios. Those scenarios could be like, for example, sales of physical products with embedded software or non-IP related services. So the circumstances they included in this ruling is quite broad, wide-ranging, including all different business models, like, for example, licenses, cloud, or hardware. So that means all these different business models could potentially trigger withholding tax on royalty. And then this ruling also provides some guidance on apportionment of payments, so that to give you an example, for example, if a software distributor makes one single undissected payment, partly for the right of use of copyright and partly to secure other rights, then these rulings require you to apportion those payments so that you can isolate the amount that is related to royalty. And then lastly, this ruling is also giving guidance saying that when there's a conflict between the domestic legislation of royalty and then the double tax treaty, the double tax treaty should prevail. So this ruling, it's quite broad. It's almost sounds a bit scary. It should have been finalized by now, but it hasn't. Why? Because there are a few reasons. One, that since this ruling has been introduced, it actually has received some criticism from overseas because it is not consistent with the OECD guidelines on royalty. For example, the US Treasury has expressed concerns over the potential conflict of this ruling with the US-Australian tax treaty and urged the ATO to reconsider its position. And then also, there's another important reason that the finalization has been deferred is because of this ongoing Pepsi court case. So the ATO has to wait for the Pepsi court case to be finalized to finalize this ruling. So that brings me to my next slide, which is the update on the Pepsi court case. So for you, those of you who have been following this case, you know that the first issue in front of the court for this case is probably the most important issue, is that the payment made by the Australian company and this exclusive bottling agreement, is it the consideration for royalty and therefore withholding tax applies? So this is the key issue being debated in the court so far. And then previously the taxpayer has lost in the lower court, but then the taxpayer has actually won in the full federal court. I think that was around June, July this year, and it was a majority win. The full federal court decision was that there's no embedded royalty to which royalty withholding tax could apply, and also the diverted profits provisions in Part 4A had no application. So the ATO has actually applied for appealing, and whether the High Court will hear the appeal, we don't know yet. But at least for now, I think it's a win for the multinationals. And then the two things probably coming out of this full federal court decision, one is that when it comes to characterize the payments and distribution or other cross-border arrangement, you should take a holistic and substance approach. And secondly is that the actual form of the arrangement should be respected unless there's evidence to disregard them. And the other element of this court case that is so important, almost a milestone case, is that it is the first time that diverted profits tax that's been debated in the court. So DPT, I think it was firstly introduced in around 2017. It's essentially a 40% penalty tax for SGEs, significant global entities. That is when they found that one of the principal purposes of the SGs entering into a scheme is to obtain either Australian tax benefit or overseas tax benefit. They could apply the DPT tax. So that's why this case has been so important and attracts so much attention in the last 2 years. Okay, next slide. So a quick update on this new penalty the government has announced in this year's budget. So as part of the 24-25 budget, the government said that they're going to introduce this new penalty for taxpayers with 1 billion turnover, basically all the SGs, in relation to mischaracterization or undervaluing of royalty payments. And this new penalty is supposed to start to apply from 1st of July 26. So we still it's still like 1.5 years away. So far, we haven't seen any consultation paper or draft legislation on this area yet. And then coincidentally, this announcement comes out, and at the same time, we're also seeing an uptick in the ATO's review activity in terms of royalty withholding tax. I think this sends the multinationals a signal that we are in a very aggressive enforcement environment in terms of royalties and withholding tax at the moment. The other update in this area is that the government has announced that it will not proceed with this deduction denial rules anymore. So this rules was firstly introduced in the 22-23 budget. Essentially, it is saying that the deductions for payments relating to intangibles held in low tax jurisdictions would be denied. And the low tax jurisdiction is defined as a country with a tax rate of lower than 15%. I think this is mostly because of the Pillar 2 tax that Joe has just covered. Because, you know, in the ideal Pillar 2 tax, Pillar 2 world, every country should have at least 15% or more tax rate. So then there's no point to there shouldn't be any countries that's been called the low tax jurisdiction. So that's the quick update on the intangible assets. That brings me to my next topic, which is country by country reporting. CBC reporting, firstly, I want to do a quick recap of the two very important definitions. One is the SG and the other is CBC reporting entity. SG was firstly introduced around 2015. I think it will be coming to 10 years next year, this concept. And then in 2019, the government expanded the concept of this SG definition, introduced this definition called notional listed company group. Essentially, an NLCG is broadly a group of entities required to consolidate as a single accounting group if a member of the group was a listed company and exceptions to requirements to consolidate were disregarded. So that just brought the scope of SG a lot. For example, the entities currently that are not required to consolidate due to the size, like because they are immaterial, they would be falling under the SG scope and this definition. And also entities not required to prepare accounts by law, for example, they are owned by trusts, they would also be falling under this SG definition. And then the country by country reporting entity definition basically is a subset of the SG population. The two definitions are quite close. The only difference is that when it comes to this notional listed company group, there's a slightly different. So for CBC reporting purpose, the notional listed company group is that the entities that are disregarded due to being immaterial should still be included. So that's different from the SG definition. But the entities that are subject to exceptions to consolidation, for example, because of investment entities and the SB 10, they should still be excluded. So in Australia, what we often see is that we have subsidiaries in Australia. The parent company comes from overseas, held by investment entities overseas, like private equity or venture capitalists. And then we come across a situation that those entities in Australia, they are a SGE, but they are not a CBC reporting entity. And then being a CBC reporting entity, that just means you have to follow you're subject to all these integrity measures they introduced for SGE because you definitely are SGE, but you have two additional reporting requirements. One is the filing of general purpose financial statements together with the filing of your tax return, and the other one is the filing of the CBC statements. So CBC statements essentially is 3-tier statements. So you got CBC report, country by country report at the parent level, usually prepared, filed by the parent. And then you got the master file, usually prepared by the parent, but filed by both the parent and the subsidiaries. And then you got the local file prepared and filed by the subsidiaries in their local jurisdictions. In Australia, the local file essentially has got two documents. One is an Excel document asking you to disclose all your international related party dealings. And the second one is what's they called a short form local file. Essentially just got 5 high-level questions. Up until now, this short form local file, we think it's the easy part of the local file because the questions are quite high level and brief. But the ATO has actually recently announced that they're going to change this short form local file. So the ATOs, I think probably 4 or 5 months ago, they announced that they will use an updated version of this local file short form for reporting period starting on or from 1st of January 24. At the moment, this updated version, they call it version 4.0, is still in consultation stage. So ATO is consulting with the industry liaison group, and HLB is actually part of this group. So we have reviewed the consultation version of this short form, and we have also submitted our feedback to this version. So in terms of the changes with this new version, I should say the changes are quite substantial. The information they are expecting in the new version is quite intensive. I can give you some examples. So instead of the 5 high-level questions, they are actually now asking very detailed, very intensive questions from 3 areas. First area being the business and strategy and key competitors. In this area, they actually expect you to report per your business line and per your business function. And then they ask you to provide organization structure and overseas reporting. For example, in terms of overseas reporting, they ask you to provide the detailed information of your overseas reporting personnel. That includes this person's name, job title, country of residency, and when they commence and cease their job. So when we were in the liaison meeting, some of the multinational has already expressed the concerns that this might even in breach of the privacy laws with some overseas countries. And then thirdly, the third area is restructure and new arrangements involving transfer, license, or creation of intangibles. Also, I can give you some examples like how detailed information they are expecting here. They ask you like the type of the new arrangements, the kind of intangibles, the capital revenue, the capital value of the restructure, the anticipated Australian tax impact, and the anticipated global tax impact, and the steps involved in the structure and the details of the steps. So we understand that the multinationals also express the concern that with lots of those restructure and arrangements happen at the overseas or the parent level, Australian subsidiary sometimes don't necessarily have access to this information. So there are lots of concerns about this new short-form local file. At the moment, the ATO is expecting to finalize this file by the end of this year or early next year. So we will send out communication in terms of the new version of this file and how we can assist our taxpayers to, fulfilling this new reporting obligation. One last thing to update in the CBC space is this multinational tax transparency. It's an amendment bill that was introduced in February 24, and then at the moment it's still sitting with the Parliament, so still in the draft stage. It essentially requires the CBC reporting parents to publish the selected tax information on a country-by-country basis. So, and those information will be made available to the public. So this is different from the local file and the master file I just mentioned. This is additional reporting and disclosure requirements, and those information will be made public. And so the reporting obligation is actually imposed on this entity called CBC reporting parent. So what is a CBC reporting parent? Broadly, it's the head entity of a group with 1 billion turnover, and then one member of your group needs to be an Australian tax resident or Australian PE, and then at least 10 million or more of your aggregated income should be sourced from Australia. Then if that's the case, you have the obligation. So with lots of our multinationals, they're probably a subsidiary in Australia. So it sounds like, it's their parent company overseas that will have this filing obligation. But if you think at it at a practical level, I don't think the ATO will go overseas and chase up the reporting obligation of the parent company overseas. So it is most likely that this filing obligation will be left with the Australian subsidiary or PE to manage. And once this bill is enacted, it will start to apply for income years commencing on or after 1st of July 24. So for lots of December year-end clients, I think the first year will be the year starting from 1st of January 25. And then on the right side of the slide, it's essentially list the information that expect you to disclose and this new reporting regime, names of the entity, your approach to the tax, and also your number of employees, revenue, profit loss, book value of intangibles, income tax on cash basis, and income tax on accrual basis. I think that brings me to the next topic, which Joe will present. So Joe, I'll hand the microphone back to you.
Thank you very much, Joey. So just to cover briefly an announcement which came through in the last federal budget and is proposed to have application from the 1st of July 2025. And what's involved in that is that there's a proposal to expand the level of disclosures that are required to be made by non-resident entities, in particular when they make a sale that has some kind of relationship with Australia of greater than $20 million. Now, under the existing Australian capital gains regime, non-residents are subject to a greatly restricted level of exposure to Australian tax on capital gains, broadly speaking to a direct interest in Australian real property or an Australian real property interest which is held through some kind of entity arrangement in which the major asset is Australian real estate. Now, a couple of different changes that are proposed through this changed legislation is to standardize the definition of real property, which currently feeds back into state-based rules around chattels. And so what we're finding is that depending on how those rules operate, there's different levels of definition for real property, which apply on a state-by-state basis. So that proposes to create a solidified and standardized definition of what comprises Australian real property for the purposes of these disclosures. Also, that it proposes to change circumstances such that it's now mandatory to notify to the tax office and also to a prospective purchaser if you feel or would indicate that the disposal is not Australian real property. And I suppose what the tax office sees this as doing is because there's a notification of a transaction which is not subject to the tax on Australian capital gains in circumstances where the transaction exceeds $20 million, that they will have a greater opportunity to scrutinise the type of transactions which are being conducted by non-residents in disposing of assets which may or may not have a substantial Australian component to them. Now, the challenging part from a transaction perspective is that we expect that the notification requirement from a selling foreign resident will take place some period before actual completion, and it will also be required to be made on or before the time at which the CGT event happens. Now, for Australian tax purposes, of course, that will happen when the contract is settled. So we've got an expectation here of the revenue authorities getting visibility over a transaction at or before the time it actually gets signed. And then there is a waiting period between exchange and settlement, which will be mandatory if you're dealing with a transaction within this space. What's not really dealt with very thoroughly and what's not clear to us as advisors at the moment is what exactly will be the trigger for something which requires disclosure. For example, it's very clear that if you're disposing of shares in an Australian company, that will have a disclosure requirement. But as frequently happens, the disposal of an underlying Australian interest can happen a number of different steps up the corporate chain. So at what level will the tax office expect people buying and selling entities that have some kind of business being conducted in Australia to actually notify the tax office on an underlying basis? And that was all from me.
Thank you, Joey and Joel. We don't have any questions, but do you have any last thoughts or key takeaways for our participants?
Well, I guess my one thing would be a lot of those changes like Pillar 2 and changes to Thin Cap, we will have a much greater time to deal with them on a compliance basis. But of course, the need for finance teams to be ready for their first reporting period is right here, right now. And also the ability to get through audits without qualifications is very prominent right now.
Thank you. And any last words, Joey?
Similar to Joe, I think that there's lots of changes, updates happening in the international tax space. I think both advisors and taxpayers should, try their best to keep on top of those updates and be compliant with all these new rules.
Great. Well, thank you both. I'd like to thank both Joel and Joey for their presentation today. If you would like a call back to discuss any of the topics presented today, please complete our poll question and either one of our presenters or a HLB representative will contact you directly.